The market just took a dive, but what's really going on? Multiple analysts like Lark Davis are calling it a final shakeout before the next big run. It seems the dip was caused by a weak jobs report and fears about the Fed, which wiped out over $1 billion in leveraged trades. But here's the interesting part. George from CryptosRus revealed a single whale snapped up $300 million in ETH during the chaos. Cowen's data shows we might be in for slower gains this cycle, but the new Bitcoin ETFs could throw all the old rules out the window. Meanwhile, Cardano's Charles Hoskinson is fighting back against rumors with a full public audit. It's a messy market, from high-stakes institutional moves to the pure speculation of meme coins. So, was this dip a warning sign or the last chance to get in? In the latest video from Altcoin Daily, the channel kicks off with what's presented as breaking news from the Trump administration, detailing a new plan to make America the crypto capital of the world. The segment features Bo Hines as the U.S. White House Crypto Executive Director, who outlines a 160-page report and a three-phase approach. This plan involves demolishing old regulations like Operation Choke Point 2.0, constructing a new stablecoin framework called the Genius Act, and implementing tax reforms and consumer protections. The opening segment of this video is a clever piece of satire. The breaking news from the Trump White House featuring Bo Hines is a well-known parody that uses deep fake technology. While it's not real, it effectively sets an outrageously optimistic tone that frames the rest of the video's analysis. The interesting part is how it uses this fictional setup to discuss a very real trend: the growing political and institutional acceptance of crypto. The points about Larry Fink and the massive inflows into Bitcoin ETFs are factual and represent a significant shift in finance. The video's core argument, that regulatory clarity on stablecoins would be a massive catalyst for Ethereum, is quite compelling. While Bitcoin gets the spotlight as digital gold, Ethereum's utility as the main platform for stablecoins and decentralized applications means its ecosystem could see explosive growth from this kind of policy. The video does a good job of blending humor with a serious market thesis. In the latest video from the Crypto Rover channel, he announces a special promotion with the WEX crypto exchange. He describes it as a huge sign-up bonus where new users can get a $1,000 Ethereum trading position airdropped into their account. To get this, you must use his exclusive link to sign up before August 10th. The process is straightforward. Download the WEX app, create an account, and complete the simple onboarding tasks. The Ethereum position should appear in your account within 72 hours. He also mentions an optional bonus. If you deposit your own money for futures trading, WEX will match your position size 100%, essentially doubling your trading power. He warns that this is strictly for new users, and the platform actively checks for people trying to create multiple accounts. This type of promotion, offering a large trading position bonus, is a very common and aggressive tactic for newer or smaller exchanges like WEX trying to capture market share quickly. The offer of a $1,000 Ethereum position is appealing, but it's important to see it for what it is: house money to trade with, not a cash gift you can immediately withdraw. You typically get to keep any profits you make from trading that position, which is the main appeal. The real goal for the exchange is to get users comfortable on the platform and encourage them to make a real deposit, which the optional 100% position match is clearly designed to do. It's a clever way to lower the barrier to entry for new traders while incentivizing them to eventually trade with their own capital. In the latest video from the Crypto Tips channel, the host breaks down the wild and unpredictable world of meme coins and low-cap altcoins. The video explains that these coins don't rise because of technology or real-world use. It's all about pure speculation and social media momentum. Using Dogecoin's 15,000% surge and Shiba Inu's 100,000% gain as prime examples, the host shows how community hype drives prices to insane levels. To avoid getting burned, the video suggests checking a few things before jumping in. First, look at the community's engagement on platforms like X and Reddit, and use tools like Lunar Crush to see if the hype is real or just bots. Next, check the token's liquidity on sites like DexTools or CoinGecko to make sure you can actually sell without crashing the price. It's also smart to look at token distribution on Etherscan to see if a few insiders hold most of the supply, which is a major red flag. For low-cap altcoins that claim to have a purpose, you can check their development activity on CryptoMiso. The video lays out 5 simple rules for this space. Never invest more than you're willing to lose, take profits aggressively, don't chase massive green candles, focus on tokens with good liquidity, and know when to cut your losses and walk away. The advice in this video is solid, evergreen wisdom for anyone looking at the riskiest corner of the crypto market. The principles of checking liquidity, community, and token distribution are timeless. However, it's interesting to see how the meme coin game has evolved since the Dogecoin and Shiba Inu era the video focuses on. The current cycle is dominated by meme coins on faster chains like Solana and Base, where tokens can be created and go viral in a matter of hours, not weeks. We're also seeing a new chaotic trend of celebrity-backed meme coins, which adds a whole new layer of volatility. These often pump incredibly hard on a celebrity's announcement and then dump just as quickly, making the strategies mentioned in the video, like taking profits early and not getting emotionally attached, more important than ever. In the latest video from Lark Davis, he breaks down the spicy crypto market sell-off from the weekend. He says it was triggered by some bad macro news, specifically a weak U.S. jobs report, which spooked investors. But he's not worried, calling this a final shakeout before the next move up. For Bitcoin, he points out that the drop was a totally normal retest of the previous all-time high around $112,000. He sees this as a technically bullish move that defended the 50-day EMA and reset the MACD indicator. He's still looking at a potential local top for Bitcoin around $150,000 to $166,000. For altcoins, he notes that Ethereum held up pretty well, staying above its key moving averages, but it's still battling major resistance at the $4,000 level. Solana, on the other hand, got hit much harder, dropping all the way to its 200-day EMA, which he thinks could be a decent spot for a risk-reward trade. He also looks at XRP, which is at a major decision point, pushing against a downtrend line that could lead to a massive breakout if it pushes through. Lark's take that the market dip is tied to macro factors like the U.S. jobs report is on the money. That kind of economic data directly influences the Federal Reserve's decisions. The market is now heavily anticipating an interest rate cut in September, which historically makes risk on assets like crypto more attractive. His analysis of the Bitcoin chart as a healthy retest is a common perspective among technical traders. When an asset breaks a previous high, it often comes back down to test that level as new support. If it holds, it's a strong sign. The fact that this dip also flushed out a huge amount of leveraged long positions, as he mentioned, cleanses the market and can create a more stable base for future price increases. It's a classic case of shaking out weak hands before the market continues its trend. In the latest video from the Cowen channel, he takes a look at Bitcoin's market cycle to figure out where we might be heading. He points out that we're likely seeing diminishing returns again. 2 cycles ago, Bitcoin shot up over 100x from its bottom, and last cycle it was about a 20x gain. So far this cycle, we're at a 7x return. He uses a few different ways to measure the cycle's length to see how much time we might have left. It's interesting to see the data laid out so clearly. Cowen's approach of using historical cycle lengths is a classic, data-driven way to temper expectations. His theory on diminishing returns in a 2026 bear market is a pretty common view among longtime market watchers. However, the big elephant in the room this cycle is the U.S. spot Bitcoin ETF. The amount of institutional money flowing in is something we've never seen before, and it's creating a major debate. While history suggests a cooling-off period is on the horizon, some argue the ETFs could break the old patterns, potentially leading to less severe drops or even a longer rally. This makes his sober analysis a great baseline, but the ETF variable is the wild card that could change the game completely. In the latest video from the CryptosRus channel, George gives his take on last week's crypto market dip and what he expects for the week ahead. He says the pullback was mainly caused by 2 things: fears about the economy and a massive wave of liquidations. The trouble started with the FOMC meeting, where Fed Chair Powell hinted that a September rate cut might not happen, which made investors nervous. This was followed by a weak jobs report, which further spooked the market. These events triggered over $1 billion in long liquidations, with market makers pushing prices down to wipe out traders. George's breakdown of the recent market action as a classic liquidation cascade driven by macro jitters feels spot on. It really shows how much the crypto market is now tied to what the Fed says and does. The shakeout of over-leveraged traders is a familiar pattern, and it often sets the stage for the next leg up by clearing out weak hands. The fact that a single whale bought $300 million in ETH during the panic is a very bullish signal of underlying strength and conviction from big money. However, the market seems to be stuck in a holding pattern, reacting nervously to every bit of economic data. While his optimism for a recovery week is encouraging, it feels like Bitcoin will probably chop around in its current range until there's a more definite signal, either from inflation data or a clearer stance from the Fed on rate cuts. The upcoming jobless claims are definitely the next small piece of that puzzle. In the latest video from DataDash, Paul Sampson talks about the crypto market after a weekend drop. Bitcoin fell to around $111,000, but has since recovered. He sees this as a healthy retest of the previous all-time high. For the upcoming week, he's looking for Bitcoin to potentially pull back slightly to the $113,600 area before making a move toward his weekly target of $118,000. Looking further out, he still believes Bitcoin is on a slow path toward $130,000 by September, and he expects a sizable correction to happen once it reaches the $130,000 to $140,000 zone. Paul's take on a slow burn up to a new Bitcoin high feels very grounded. The idea of the market cycle lengthening is a popular theory right now. Instead of the explosive, vertical peaks we saw in past cycles, the market seemed to be moving in more sustained, drawn-out waves. His forecast that Bitcoin could grind to $130,000 by September, only to face a major pullback from there, fits this narrative well. It suggests the top might not be a single event, but a whole price region we trade in for a while. This also lines up with his long-term view on the ETH-Bitcoin pair, where he sees a full-blown alt season taking another year or more to mature. It's a perspective that treats crypto less like a get-rich-quick scheme and more like a maturing global asset class. In the latest video from The Modern Investor, the host talks about two main stories stirring up the crypto space. First, he covers the drama surrounding Cardano. Apparently, there have been accusations flying around that the Cardano team, specifically Input Output Global, IOG, misused about $600 million worth of their ADA holdings. In response, Cardano's founder, Charles Hoskinson, has ordered a full audit of the company's funds, with the results expected to be made public by mid-August. The host believes this is just the usual mudslinging that happens in bull markets when a coin's price isn't pumping as hard as others, leading to investor frustration and finger-pointing. He points out that this isn't the public's money and compares the situation to past accusations against Tether and the Ethereum Foundation. It's interesting to see how Cardano is handling these accusations. Charles Hoskinson's decision to conduct a public audit feels like a strategic move to directly confront the FUD, fear, uncertainty, and doubt. Cardano has always positioned itself as a more academic, peer-reviewed project, which can sometimes clash with the market's demand for fast-paced action and price pumps. This drama highlights that tension perfectly. The project is making steady, albeit slow, development progress. But when the price lags, some parts of the community get restless and look for someone to blame. The audit is a way to prove transparency and hopefully put the rumors to bed. Meanwhile, the news from India is a powerful signal. The Indian government has taken a rather strict stance on crypto with high taxes, yet wealthy investors are still pouring in. This suggests they see crypto not just as a short-term trade, but as a long-term asset class with potential that's worth navigating a tough regulatory climate for.